Welcome to our Nonprofit Executive Luncheon Series hosted by Centura Wealth Advisory and PBO Advisory Group. Thank you for joining us. I'm Dana Levin, and I'm Centura's Manager of Philanthropic Strategies. I oversee our Centura Foundation, provide education and guidance around our philanthropic client strategies, and build our nonprofit partnerships. Many of you I have previously met, but for those who I have not yet been introduced to, thank you for joining us and welcome. I look forward to the opportunity for us to connect. Before I joined the team at Centura last year, I was a nonprofit fundraiser just like many of you. I had some understanding of financial transactions that had charitable benefits, but I never had someone in financial services reach out to me and offer to engage with me and my organization to support our fundraising efforts. I'm passionate and deeply committed to building partnerships and helping you all to raise more money to do your impactful work. So here we go. But before we dive in, please make sure that your camera is on if you are able and ensure that you are on mute. I also want to let you know that today's presentation is being recorded. Also, in yesterday's confirmation email, there were instructions to download the worksheet that you will want to have handy as we walk through today's presentation. Please make sure you have it printed or use the fillable PDF on a second screen. This is not something that anyone will see except for you. Finally, if you have questions for our speakers along the way, we would love to hear them. Please type your messages into the chat or chat them to me privately, and I will field them to our presenters. I'll introduce you to our speakers in a moment, but first I want to lay out the roadmap for our conversation. There are 4 parts to today's presentation. First, Rick will discuss a client case with legislative proposals and review potential changes. Next, Kyle will highlight why a CLAT would be a valuable tool for this client to achieve their goals. Then we'll walk through a strategy and solution together. Finally, we'll close with how to secure a CLAT from your donors, partnership opportunities, and next steps. We hope that you find the next hour productive, engaging, and meaningful. You're going to hear about tax changes, creative ways to increase donations from your current donors, and better understand strategies for engaging your donor base more effectively. As most of you already know, it's much more expensive to acquire a new donor than to focus on retaining donors who have already given to your organization. Today, we are going to give you tools and information to educate your donors, to both keep them engaged and to motivate them to give you more money for your annual campaign. That's right. This is not a planned giving strategy. It won't be 50 years before you see this money. The strategy that we'll be focused on today can get you annual campaign dollars this year. So, now raise your hand if you know who this famous family is. Yes, many of you know that it's Jacqueline Kennedy Onassis and her family. What you might not know is that she popularized CLATs. CLATs have a long and rich history in estate planning. They've become even more prevalent in the last 5 to 7 years because they work well from a transaction point of view when interest rates are low, which they are now. As a result, many families are using the current environment to plan their philanthropy for the next 20 years. You'll definitely want to get in on this. And now, someone who has great experience and knowledge about CLATs from the accounting field is our first presenter, Rick Dahlside, who is the CFO of PBO Advisory Group. Rick enjoys sharing his strengths and plan to introduce operational and cost control initiatives, ultimately driving greater social awareness and mission impact. Rick has unique expertise in the nonprofit sector, having served in the Chief Financial Officer position for the past 17 years in the areas of healthcare, human services, conservation, senior services, performing arts, higher education, and many more. Since the early 2000s, Kyle Malmstrom has been placing clients first and serving as a steward and fiduciary to high net worth individuals and families. Kyle is the managing director at Centura Wealth Advisory and empowers his clients through educating and implementing proactive wealth planning solutions. Kyle has over 25 years of active experience in financial markets, including 6 years as a NASDAQ market trader. Thank you both for joining us today. And with that, I'd like to turn the floor over to Rick. Rick, I think you're on mute.
Good afternoon, everybody, and welcome. Let me join Dana in thanking you all for being here with us today. We hope to provide you with some very timely education and innovative ideas to help strengthen your contribution revenue streams. Today, before we talk about those revenue streams, I want to first give you a little introduction and give you forth a case study that we will be using throughout today's presentation. The case study is of a typical high net worth donor family here in San Diego. As you can see from the slide here, we're going to be talking about this client family who's worried about selling and paying capital gains, but that's not everything. So our donor family has an estate valued at $15 million, including some inherited appreciated stock, which has grown to a value of almost $8 million. So far, the family wishes to pass on some of the wealth to the next generation, along with giving to a favorite charity. This is where you insert your organization's name. The family does not have any kind of structured giving plan and desires that they have a more meaningful and strategic plan. The family would also like to give away their assets during their lifetime in order to see the impact of their giving. Like you, they may have been hearing some of the legislative plans for 2021 and beyond with regard to taxes, and they're concerned in preserving their wealth. So let's review where things stand today. On the next slide, we're going to quickly review the estate tax and income tax picture for our donor family. First, the estate tax picture. With respect to the exemption, and remember, the estate tax exemption is the threshold at which an individual estate is subject to the estate tax. The estate tax is a tax on your right to transfer property at your death. So we have two things, the exemption and the estate tax. As you can see from the graph, the estate tax exemption was relatively non-existent until it started inching up in 1980. With the Tax Cuts and Jobs Act, we see there is almost $12 million, or $11.7 million to be precise, for 2021, as the exemption is indexed for inflation. The downside of the exemption that is in place now is it's going to sunset or go away in 2026. That's only 4.5 years away. When that sunsets, the exemption is likely going to fall. Second, we're going to talk about the estate tax rate, which is applied to the amount of the estate that's left over after the exemption. And we'll talk about that in a little bit more detail. We'll see some slides that calculate that. So let's do that right now. Next slide, please. So the chart on the left highlights what the donor family will likely experience if nothing changes other than the sunset of the Tax Cuts and Jobs Act. If you remember, we're estimating that their total taxable estate to be $15 million, and that includes the appreciated stock of $8 million. In the first column, you see with the current estate tax exemption of $11.7 million per individual, that their exemption eliminates any exposure to the current 40% estate tax. So therefore, they have no estate tax liability. However, in the second column, and after the sunset of the Tax Cuts and Jobs Act, that same estate is now subject to tax. You may be thinking, what changed? Well, there has been some chatter that after the sunset, the exemption could go down to $6 million per individual, thereby reducing the estate tax exemption from $23.4 million, again, 11.7 per individual, down to $12 million. This has the potential to create a taxable estate of $3 million. And if we use the same estate tax rate of 40%, well, you've just increased the government's tax revenue stream in the amount of $1.2 million. Moving to the chart on the right and comparing current law to the proposed legislation, one current proposal is that the exemption would be reduced to $3.5 million, allowing for a combined $7 million exemption. I realize we're talking about a lot of numbers here, but bear with me. We'll get through this. Another component is a progressive increase to the estate tax rate, beginning at 45% and topping off at 65%. From the chart on the left, you see that the estate tax rate is 40%, and now we're talking about a proposal to bring it up to 45%, stepping it up all the way to 65%. Using the initial proposed rate of 45%, along with the reduction of the exemption, yields a total estate tax of $3.6 million. So let me take a pause for a moment and check in with Dana to see if there's any questions.
Nope, I don't see any in the chat quite yet, Rick.
Great. Let's move from the estate tax topic to the income tax topic and the next slide. One of the benefits we currently enjoy from the Tax Cuts and Jobs Act is the step up in basis of appreciated stock. You might remember that we talked about they had $8 million of appreciated stock. In general terms, a step up in basis means that those that inherit appreciated stock receive a new cost basis equal to the value of the stock when they inherit it. Again, in general terms. Well, this means a lot. With appreciated stock of $8 million, anything that they sell is going to be subject now to long-term capital gains tax because it's considered a long-term capital asset. And the benefit of that, you might say, what's the benefit? Well, if you might remember, the current maximum tax for that type of an asset is 20%. So as long as the receiving generation doesn't sell the stock, there's no income tax effect. What we've been hearing, though, regarding the potential changes that may be coming include the elimination of the step up in basis, as well as increasing the long-term capital gains tax rate to 39.6%, virtually 40%, doubling of that. In our example, the $8 million appreciated value of stock, if sold, would incur $3,168 of income tax. So with the sunset of the Tax Cuts and Jobs Act, along with anticipated changes in the income tax rules, there's a potential of exposing this family to an additional tax bill of almost $7 million. 3.6 from the estate tax and 3.2 from the income tax. Now let me pause for a moment and check in with Dana to see if there's any questions.
Oof, that's a lot of numbers, Rick, but I think people are just trying to process and digest some of what you said, but I don't see any questions quite yet.
All right, well, I'm turning it back over to you, Dana. Thank you.
Sounds great. Thanks, Rick. When I worked as a fundraiser, I always had families who I knew had capacity, but who undergave to our organization. I was often looking for creative ways to more deeply engage them, to show them what our organization did in the community, to teach them something that might help them personally, and to encourage them to, of course, give our organization more. Now grab your worksheet and write down some donors who might be undergiving to your organization who you know have significant capacity or wealth. There are always donors who don't give outright cash for a whole host of smart reasons. Many give appreciated stock. This might be a cue or clue that this donor might be primed for charitable planning. Take a moment now to write down the names of some of your donors who like to donate stock to pay their gift. All right, that was a quick minute. All right, so now that you know the facts, problems, and goals of our client in the example, Kyle will walk us through one potential solution. All right, Kyle, the floor is all yours.
Thanks, Dana. Thanks for getting everybody here. Welcome, everybody. So I am one of the managing directors here at Centura Wealth Advisory. One of my primary roles is to help manage clients and present them with actionable and effective strategies to help meet their goals. If it's not actionable and it's not effective, why bring it to the table, right? And so today, to help you guys raise money, this strategy is super actionable. It's timely. I'm going to get into that at the end. But what I want to take away is to start with, hey, this strategy is going to do 5 things for the situation. One is going to, and I'm going to get to this slide here in just a second, but it's going to create a big tax deduction for your client today for the amount of the gift, which is super valuable. It's going to create an income stream for your 501c3 today, right? To what Dana was saying, hey, these long, if you're not going to get the money for 15 years, that doesn't help your annual raise this year. So we want to start getting money to you guys now. It's also going to create, it could create a big donation at the end of the term of the trust. So maybe it's 10 years, maybe it's 15 years. So it kind of meets a short-term and a long-term goal for you guys. And then it's going to help pass on more assets to our family's beneficiaries, their family. And then it's going to redirect money from the IRS, which a lot of clients, at least in my life, like to redirect money from the IRS to charity and just minimize their tax bill in general, right? So how many people are familiar with charitable trust by a show of hands? Rick is, Dana, Michael is, couple? Okay. Well, there's a couple of different flavors of charitable trust. Today we're going to be talking about one, and I'm going to explain why this one's relative to today's conversation. So let's recap real quick the client situation. The client has $15 million. They got $8 million of appreciated stock. They are charitably inclined. They already give money to charity. They already give appreciated assets. They want to leave all the money to their family, and they want to eliminate the estate tax. And today's strategy is going to dovetail and help with the income tax situation and the estate tax and drive money to the charities that you guys are representing. So in this slide, what we were talking about on the proposed legislation, right? If they reduce that exemption amount down to $3.5 million, maybe it's $5.5 million. If you keep your finger on the pulse of what's going on, they're moving this number around a lot. Nobody really knows where it's going to land. Bernie Sanders thinks it should be 3.5. Joe Biden ran on 3.5. A month ago, they kind of took it off the table. I don't know where it's going to end up, but all indications point to higher taxes and probably a lower estate tax exemption. And these clients are concerned about that. And they're like, hey, we want to do our planning now because this exemption is really high and we get to do some strategies today that we may not get to do tomorrow if they change the law. So this strategy we're going to talk about, there's several things we can do from an estate tax planning standpoint. We're not, for the context of this conversation, we're going to just deal with the charitable deed annuity trust. But you may have heard of spousal lifetime income trust, and there's irrevocable life insurance trust. There's lots of different strategies. But today, this charitable deed annuity trust. Sean? Okay. So from an income tax standpoint, they've been bantering around how to raise rates to fund government spending. One is to eliminate the step up in basis. That would be catastrophic to this family. One would be to increase the capital gains tax rate to 39.6. That would be twice as expensive to get rid of any stock. And so there's a real tax problem. This family is also in a high income tax bracket, right? So they're already paying quite a bit in tax. And there's lots of strategies here we can employ and explore with these clients and put in place. But this charitable deed annuity trust really helps with the income tax, helps with the estate tax, and then helps with their charitable and legacy planning all in one. So it's a really well-rounded strategy for the situation. And so what is a charitable deed annuity trust? By a show of hands, how many people have heard of a charitable deed annuity trust? All right, Michael and Ferdinand down there. Most people, in my experience, have heard of charitable remainder trust, right? Well, this is the opposite of that. And so the mechanics of it is, in this case, I'm going to call them Mr. and Mrs. Kimball. Mr. and Mrs. Kimball are going to be the grantors. They're going to set up this trust. It's an irrevocable trust. You have to have an estate planning attorney. You get the trust set up, and you're going to put money in this trust. And the trust says they are going to be the trustee. They control the trust. And there's two beneficiaries, a primary beneficiary and a remainder beneficiary. Now, the difference between a remainder trust and a lead trust is who is the primary beneficiary. In a lead trust, your organization is the primary beneficiary. That means you're going to get the money on an annual basis. It helps with the annual raise. It's predictable. It's set in stone. It's not going to change. Anything that's left over in this trust will go to the beneficiaries that they name, could come back to them. It could go to their children. In this case, they wanted to go down to their children. It could go to their foundation. So that's kind of the basics of how the trust works, right? So let's go through how we set it up. So Mr. and Mrs. Kimball there, again, are the grantors, they're the creators. We're gonna design out a strategy that works in their situation that they want. They're gonna pick who the beneficiary is. In this case, it's gonna be your 501c3. They're gonna pick how much they wanna give every year. They're gonna pick how much they put into the trust. They're gonna pick who the remainder beneficiary is, right? There's some decisions to be made. And so we help with that. And it's based on their specific situation. And we've done close to 100 of these transactions in the last 5-6 years. So we're very familiar with it. And in this case, they're gonna fund the CLAT. They funded it with $1 million, but they funded it with appreciated stock. They were already giving appreciated stock. They're getting tax deduction every time they give the money, or they don't pay the tax on it, they just give it away. But we're gonna put appreciated stock into this CLAT. And when they do that, the way this transaction works is it creates a deduction for the entire $1 million today that they can utilize against their income. Now, you have to have really high income to utilize $1 million donation in 1 year. This particular family got to use it over a couple of years, but we have clients that use it in 1 year, they use it over 3 years. You can use it a couple of different ways. In this case, it generated almost $500,000 of tax refunds for them. So, met their charitable goal, helped out the charity, saved a bunch of money in tax. So far, so good. Now, that's the income tax piece of it, right? The second half of it is from an estate planning standpoint, and I'll get into it in a second, but in order to transfer the assets down to their kids, and if the assets grow faster than what the IRS thinks it's going to grow at, and in this case, they do believe their assets are going to grow significantly faster than what the IRS thinks, there's going to be a significant amount of money in this trust. And in order to avoid the estate tax component of it, they have to file, as a formality, a 709 gift tax return. It's pretty easy, we can help with it. They file it, they say, hey, we gave away this remainder interest, and in this design, the IRS believes the remainder interest will be 1,000. We know it's going to be more. And we file it, and then whatever this trust grows to is outside of their estate. Okay? And so now you have the CLAT. They're the trustees of the CLAT, and this CLAT's going to make annual donations to your organization. Our firm, when we set them up, if we manage the accounts at TD Ameritrade, we just set it up to where it automatically goes out. And you guys, it's just on a schedule. It's just automatically done. And it goes to your organization, and you guys can count on it. And you guys can spend it and utilize it in the way that you guys see it most useful. The term of this their client's CLAT was a 15-year term. You could set it up for 10 years. You could set it up for 20. You could set it up for your life. But they did it for 15 years. And at the end of the 15 years, what I said before was whatever's left over in the CLAT will go to their receiving beneficiaries. And in this case, the way the transaction works and the way the IRS views it and the way we view it, the IRS says, hey, there's going to be $1,000 left over if the trust makes this low interest rate that we think we're going to beat. And in this case, it's going to probably transfer about $1.5 million down to their kids, estate tax free. So home run, home run, home run, right? And the schedule for the trust looks like this. This is how they set it up. 2021, 15-year term. They put in $1 million, and it's going to make an annual donation of $5,000 a year for 2021 all the way through 2035. And at the end of 2036, there's another $1,051 going to your charity. So in total, there's $1.12 million. Very sizable gift. You know, my experience is, and you probably have a similar experience, I have clients that want to leave money at the end of the day, that want to leave money to charity, but they want to see the benefit of it today, right? But they don't know how to do it. And so this is a structure where they can still control the asset, it still benefits their family, they get the IRS out, and they can see meaningful contributions to your guys' organization, so they get to see the benefit of it, right? Now we could design this where it's $10,000 a year. We could design it any number of ways. So this is just kind of how they did it. And in 15 years, the charity is going to get $1.1 million, 1.05 million, excuse me. Okay. So let's look at, just dovetailing this together and summarizing, because I don't want to get too far into the weeds and how it works. I'm trying to give a high level here. But at the end of the day, and if we go back to the goals of leaving money to minimize tax, to give money to charity, to minimize the estate tax exposure, if they don't do anything, if we had not shown them this strategy, the left side, which is the current state, just if you just had $1 million, let's just take $1 million of the 15 million bucks. We didn't do anything with that $1 million. And they just went on their way like nothing happened. Over the course of the next 5 years, they were going to pay almost $500,000 in tax. And the growth of the assets at the end of the day, based on some of the state value projections and estate tax calculations, there's another $600,000 in tax. So there's $1.3 million that they're going to pay in tax, and they're going to leave their beneficiaries close to $1 million bucks. With this transaction, and this is the power of it, and this is where it comes into play for you guys, they're going to eliminate they're going to eliminate $1 million of tax, 500 of it's on annual income tax that they would have paid if they had not done the strategy. They would have pushed the assets outside of their estate to eliminate the estate tax piece on that $1 million bucks. They would have left their kids more money, $1.5 million, and they would have gotten $1.1 million to you guys' organization. And then the attorney and the CPA get a little bit of money for filing tax return each year, but nothing, minimal, right? So massive impact, right? Any thoughts on it? I don't know, we're not answering questions here yet, but pretty powerful strategy, right? Very, very powerful strategy. So with regards to the strategy being effective, and let's go down to the next slide, Sean. I said, hey, let's make something that's effective. I think we just proved out that it's pretty effective. And in this case, I want to make it effective for you guys. 2, we want to make it actionable. Again, we've set up lots of these. I helped set up 4 just last month. And the reason we did it last month was because of this table. Last month, I did 4 different plats for a total of $1.5 million. So everybody was pretty happy. And the reason that it is timely and the reason they did it last month is because of this chart right here. And so you can type in 75/20 rate and irs.gov comes up and you can pull up this little chart. But you'll see in January the 75/20 rate. And the 75/20 rate is a rate that the IRS publishes that's used to determine the economics of a charitable trust and how it all works, right? And so they have to put a number on it, and they say, okay, hey, the number was 0.6 in January, 0.6 in February, 0.8 in March, 1% in April, and they publish this number. And to what Dana said at the very beginning, what has popularized this strategy is a very low interest rate environment. And so these are ridiculously low interest rates, but the problem is they're starting to head higher. We're starting to see a little inflationary pressure. Does it get to 1.6? Does it get to 2? Still works great at all those numbers. But economically speaking, for the client, the lower the number, the easier the transaction is for them. It's just financially a little bit better for them. And if you can eliminate the IRS, leave more money to your family, it's just easier for them to do the transaction, which makes it easier for you to get the money, right? And so the reason I say it's timely is because that rate right now is 1.2. But you get to use the lowest rate from the previous 3 months. So if you introduce somebody to this transaction today, they'd be using 1%. This strategy is super, super effective at 1%. It's super effective at 1.2, but as a call to action, I'm just simply communicating, hey, this rate's on the rise. It gives you a reason to reach out to your donors. Hey, I got this transaction. Economically speaking, it's going to be in your best interest if we talk about it sooner rather than later, right? I mean, that's what I did last month. I called up 4 clients. I'm like, hey, you guys have been thinking about it. If you're going to do it, you might want to do it. And they all said, yeah. So we did all the analysis, figured it all out, and we got $1.5 million put into class. And so kind of want to finish it up on that.
Kyle, hasn't it been good though for a long time, for 10 years or so?
Yeah, we've been doing them for 10 years. But you'll see that if you look at the number of transactions we do, we tend to do a lot more when the rates get really low like this. It's just an easier. So we do a whole bunch and all of our clients set one up, and then rates go up a little bit and they already have one set up, and then the rate drops and their income's still high and things in their life are still good. We have lots of clients that have 2, 3, 4 of these transactions. Lots of them. One of the ones I did last month was the third one. And I know Derek, I think, has some that have 3 or 4. So lots of clients come back to the well on this one and do it multiple times. And one thing I would say is they can always pay that lump sum up a little sooner. We had some clients accelerate their payments to charity earlier or late last year, and they gave a good chunk of money away to a cause that was near and dear to their heart. And man, they did this great video, and it was really, really pretty special. So I would just say, going back to the benefits of this transaction and just some talking points, and it's big IRS, big tax deduction today that they get to use for the entire amount of the contribution. Right, so if they put in $500,000, they're going to get a $500,000 deduction that they can use against their income today. It's going to create an income stream for you today, for your organization, that you don't have to wait for, meeting those short-term goals. Likely, not always, but likely there's kind of a lump sum at the end of a 10 or 15 or 20-year term. Kind of meets some of the plan giving schedules and can work out pretty well for you there. It's going to work out better for their beneficiaries. I do have clients that are going to leave that to their foundation. And sometimes they don't feel so wealthy and they say, I'm going to leave it back to myself. And then a few years later, like, well, I don't really need it. I'm going to send it to my foundation. And it just, the more money they have, the more they can give to charity. And the transaction in general just creates more wealth based on the mechanics of it right now. So we are here to help in any way we can. I'm happy to have conversations with you guys individually. I think we're going to do another presentation getting more into the nuts and bolts of how it works. In terms of takeaways, I'm right at the center of knowing someone's financial situation in great clarity. And it's obvious you guys don't have tax returns and balance sheets and things like that. But my suspicion, and you guys could attest to it or not, but you can probably tell someone's net worth in general, kind of their income based on, where they live, where they work, just how affluent they are, how much they give. You guys know these donors personally. My suspicion is you have some idea. You don't have to have all the facts to just say, hey, I heard about this transaction. Here's how it could work. Is it worth having a conversation about? That's really all it is.
Excellent. Well, thank you so much, Kyle. So now you all have learned about a strategy that will save your donors taxes and also get you larger gifts, of course. So grab your worksheet again and let's look at question 3, which is, who do you think might benefit the most from learning about a CLAT transaction? Take a second to write down a couple of your donor names. Alrighty, and now for those who have previous experience with CLATs, or as you're just starting to think through what you might say to one of your donors when you speak with them about a CLAT, what obstacles or objections do you foresee in your conversations? Take a second to write a few of those down as well under question number 4. So we'll start with the questions under number 4 to kick off our Q&A. So I got one question that was sent to me, which is for you, Kyle. What if I don't know if my donor has a tax problem? What kind of questions could I ask to encourage them to share this information with me?
I would go and you could just simply notate that, hey, in the past, you have given quite a bit to the charity, and I know you're charitably inclined. Usually there's a tax benefit associated with that. I'm not sure if that's the primary reason you do it. Usually it's not, but there is a strategy I've heard of that could make a big impact, and you get a big deduction for the amount of the contribution today, but you don't have to give all the money away today. Would that be helpful, right? Could you, would having a $200,000 or $300,000 or $400,000 deduction be helpful? Would, I don't want to get into it, but if you're in the highest tax brackets, I have a transaction that would work really well that could benefit your family, the charity, and create a big deduction, right? So you kind of got to feel it out a little bit without asking very specific questions. I guess you could ask a pointed question if you wanted. That's probably how I go about it, just talking in generalities and trying to get to the heart of it. Just finding out, is this of interest, right? Would a big deduction be of interest, right?
Super, thank you.
Kyle,
That's
I
really...
think, oh, sorry, Dan.
Go ahead, that's okay.
Kyle, I think oftentimes there's a lot of donors that say, I'm going to give more, but I'm worried about giving it too soon. Is there a way here that this would be a good transition for those folks who are saying, you know, yeah, it's in my trust or in my will to potentially do this down the road? Would those people might be a good opportunity?
Absolutely. So I have a client that they're going to leave everything, not now, but they are going to leave everything to charity at the end of the day. And from an income tax standpoint, there really isn't an income tax benefit to leaving it when you die. There's an estate tax benefit to leaving it when you die, but you don't get to see the value of it, right? And so this transaction pushes the donation, even though the money doesn't go away for 15 or 20 years, pushes the donation today, so they get a big tax deduction today. They still control the money. They get to give away the money today. It ultimately will go where they want to. Either, you know, you can set it up at their lifetime, but I kind of like doing it on a term. So I guess the short version to Derek's question is they accomplish the same thing, but they get benefits today by setting up a structure like this, right? You can have that remainder piece come back to them. Actually, we use it kind of to benefit retirement plans often, because we can generate more money using the IRS's money. That's ultimately what we're doing here, because you don't have to pay the tax on it. But you can definitely frame it where, hey, this transaction would still benefit you today, even though I'm not sure I have enough money. I want to give it at the end of the day. Hey, would a tax deduction be helpful today? Wouldn't more money in your pocket be helpful today, right?
But there's the second benefit, right? You get the income tax benefit, but it adds the context of them seeing their money go to work today and adds context to their life that says, wow, they feel far better about it.
They get to enjoy their legacy now as opposed to posthumously, which is huge. I've seen that play out myself a number of times. Another question, and I think Derek was right on that. What about the use of insurance, in this mix, whether that's for replacement wealth or to add to, in terms of their progeny or their foundation, whatever their legacy is ultimately going to be?
You can do it. It's trickier. It's a split gift. There's more complexities to it, but you can do it. We can show you how to do it. I don't want to overwhelm everyone with the technical details on it.
Super. Thank you all. Kyle, we have another question, a couple of questions that folks typed into the chat. One back to the estate tax exemptions. So when does the exemption sunset if nothing changes now, and what will that amount be?
So if they don't change the exemption, it will sunset in 2026. And the technical math piece is it's going to sunset based off of 5.4 million with cost of inflation. Everyone estimates that to be about $6 million. So in 2026, it's going to be really close to $6 million, plus or minus.
Thank you. Now, we also have a question that reads, your example was $1 million CLAT. Is there a minimum amount of money that you'd recommend for setting these up? And also, what is the average term that you see for CLATs?
Great question. So if you are truly charitably inclined and you're not doing it for any tax benefits, and it's just, hey, I want to get this thing set up. I mean, obviously there's a tax benefit, but if you're truly charitably inclined, 200 grand is probably as low as I would go, because you got to pay for the trust, you got to pay for a tax return. You want the economics of it to work. 350 is probably a good number. 300, 350 is probably a good number. And the higher, the bigger the CLAT, the better the economics for the remainder beneficiary, because you have a bigger number with lower compliance costs, right? And as the interest rate goes higher, kind of the break even of the whole thing gets a little bit higher. But I've done them for 200 for sure, but I like 350.
And is there a maximum? Like, how do you figure out how to size these things? You know, you said that some people
great. I want to find the person that wants to max it out. That's
right?
The person we want to talk to right there, right?
Sure.
As far as I know, there's not theoretically a maximum. I mean, the issue with the maximum is, from a tax perspective, the tax deduction is usually a very valuable component. And the tax deduction, you get to use it. I don't want to get into the calculations of it, but you can use it up to 6 years, and you can only use so much of it against your income. And so what you don't want to do is end up having this deduction that doesn't go against income that you don't get to use. So that's generally not favorably looked upon by our clients. So I like to use the deduction within 2 or 3 years of their income. That way, there's just too many wild cards that happen in 4 or 5 years. So the deduction's kind of, the way we calculate it, the way we usually advise our clients, is kind of based on their income, and that would be something we help with. Hey, what's the flavor of your income? What's your income? What are you going to put in there? There's some math to it, but theoretically, you could put as much in there, but practically, it's going to be based on the amount of deduction that you could use over a number of years.
So it would probably make sense to have a couple of them starting at different points versus having one huge one and wasting part of the deduction.
Yeah, absolutely. I think for people making $1 million, just to give some context, right? Somebody that makes $1 million, probably a good number is $1.5 million, because they can use maybe between $1 million and $1.5 million, because they can use $333,000 a year times 3 years is $1 million. All right, so $1 million, maybe a little bit more. Just kind of depends on what their situation is.
And also, there's a follow-up question to that. So once someone creates the schedule of the annual gifts that are going to be made to the organization, can they change that amount? So if they set it up, on a $5,000 a year schedule, can they change it to $10,000 over time? How does that element work?
So if you put $5,000 in as your annual payment, that is the minimum that you have to pay. If you put in $10,000, you have to pay $10,000. You can't change it lower. So the schedule as it's set up in this client's situation is $5,000 with a balloon payment at the end. If you total up that 1.12 million, the collective amount, they are obligated to make that entire collective amount, whether they do it in 1 year or 15 years. They have to make the 1.12 million. So they can accelerate and increase the donations at any point they want. They just can't go below that minimum amount they put in.
Got it.
So
That
we
makes
create flexibility. They wanted some flexibility. They set it at 5,000, knowing that they're probably likely going to accelerate it, but in tight years or whatever it is, they wanted a little bit of flexibility. So we kind of give them, that particular client gave them the optionality to put more on an annual basis, but said, hey, your minimum's 5, which is what they were comfortable with.
Got it. Okay, that's great. Someone else asked, what is the potential downside of a CLAT transaction for the donor?
If they don't get to use the tax deduction, right, that would be, at least for our clients, we're trying to usually minimize tax and charitable benefits at the same time, and we're meeting lots of different goals. So if they don't get a chance to use the charitable deduction, that would be a downside. And that could be from, a loss of, what if you got injured, you couldn't work and you didn't have the income, which is why we don't make that deduction go too far out. So that would be the first potential downside. The other would be if you're really planning on the money, the remainder beneficiary getting a lot of money, in the event that the trust does not beat what the IRS's expectation is, which is a measly 1%, the remainder beneficiaries wouldn't get anything. But that in context in and of itself isn't necessarily a bad thing, because your client might want to give that $1.1 million away anyway, so it's really no harm, no foul. If the investments didn't perform and they went south, the charity could potentially get a little bit less than originally was contractually obligated to, right? But they're still going to get a pretty good chunk of money, because you're going to manage it in a very balanced way. That's fiduciary responsibility. That you're going to beat the 1% over time, but that is one other thing that could happen. Another would be, and there's a solution here, and I definitely don't want to get into it because it's pretty technical, but if you pass away before the end of the term, there's a tax implication for the amount that you haven't given that comes back to you. There's a solution to mitigate that, but you should be, if you're 85 years old, you don't want to set up a 30-year CLAT. I mean, it's just not going to, you could, but you're probably not going to.
Sure.
You want to try to live the term of it.
Sounds like a plan. Good goals. What happens if conditions change after the CLAT is set up? Is the CLAT locked in for the term of the CLAT, or can it be revised?
The CLAT's an irrevocable trust, so you are locked in contractually to that. The flexibility you have in a CLAT would be you could change trustees, right? You don't necessarily have to be the trustee. You could name somebody else as the trustee. If they were incapacitated, you could change trustees, or you don't like them anymore, you could change trustees. In your guys' case, I wouldn't necessarily bring this up to the client, but because we want you guys to get the money, but they could change the beneficiary of the trust. If your organization ceased to exist, they could change the primary beneficiary of the charity, right? There's some flexibility, but in general, from a financial standpoint, the financial obligation that you made, you are contractually obligated to make.
Yeah, because it's an irrevocable trust.
Yeah.
Great. So if an appreciated asset is donated to the CLAT, would it bypass the gain if sold and the funds reinvested into the CLAT?
Great question. This trust is this is technical. So the trust is set up as a grantor trust, which means that the tax implications of the trust flow back to the grantor, the creator. So if you put the appreciated stock in there and sell it, you're going to get a tax bill. So there's some planning we can do to help with that for sure. But you generally want to try to avoid big taxable transactions once it's in there. There's some, at the end of the day, it can be pretty effective. You can get rid of the appreciated stock to the charity. But if you put the appreciated stock in there with the idea that you're going to sell it all, you got a big deduction. It's just probably not the most effective use of the deduction. That would be kind of an individual situation where we'd want to dial in exactly what we want to do, but I mean, you would have a deduction for the sale, so, but technically the tax implication comes back to you.
So similarly, under what circumstances would it make sense to fund the CLAT with real estate?
We like real estate and CLATs.
We do.
Yeah. There's a lot of instances where you want to put real estate into a CLAT for sure. There's a lot of good tax benefits to real estate that go along with the trust, so I'll just leave it at that.
Perfect. Sounds great.
It's a very tax efficient asset. So kind of to the previous question about selling the stock in there, if you had the real estate in there, that would help with the situation.
Perfect. And then what if the donor wants to benefit multiple organizations? Can they do that?
Absolutely.
Perfect. Fantastic. Even better. And then can you make a second gift with the remainder? How does that work? You know, maybe for somebody who has a donor who, you know, doesn't have any children or doesn't have any heirs to give it to, can you make a second gift with the remainder? How does that piece work?
Not quite exactly sure what a second gift is, but our clients will drop it into a foundation, and then the family would manage the foundation, which would then meet their 5% obligation to the different charitable causes that they have. I think that's what you mean by a second gift.
Well, if somebody potentially wanted to take the money that would have passed to their beneficiaries, so that 1.5 million, could they then, in addition
redirect it?
Yeah, instead of in addition to the 1.1 million that the organization is guaranteed, could they take that 1.5 and make the organization also the beneficiary, or a different organization, I guess, potentially, if they didn't have children, they didn't have heirs, they didn't have any friends and family, I don't know who that is, but in theory,
absolutely.
Could they take that second amount and also donate it to the organization?
Okay, I got you. So if let's say you don't have any kids and you're gonna leave everything to charity anyway, yeah, you make the primary beneficiary, the lead beneficiary, the charity, and then you make the remaining beneficiary of the charity. Absolutely.
Okay, perfect. Sounds great. I don't see
I got caught up on the second gift piece of it.
That's okay. It's all good. More money, the better. I don't see any other questions. So now we'll move on, but hopefully your worksheet is your crystal ball now to show you your future donors to engage in a conversation. As you completed the worksheet, you should have narrowed down your donor families to a small group who might be perfect to consider a CLAT or other charitable giving strategy. But now the real question is, what are you going to do with this goldmine of fundraising data? What I would suggest is that you reach out to one or two of your donor families today who you've identified on the worksheet and invite them to part 2 of this workshop on the 24th. We'll take an even deeper dive into the logistics and cost-benefit analysis of how a CLAT works both for the organization and the donor to bring even greater clarity and understanding for everyone. Call your major donors, call someone who you need an excuse to pick up the phone and reach out to, who fits the key profile that Kyle outlined earlier. You're offering them an hour of education for an organization that they already care deeply about. It's a win-win for everybody. Kyle, Rick, and I want to be your partners and help you drive even greater donations from your donors as they consider how more sophisticated planning strategies might be right for them and where an introduction to Centura might be valuable for all. We know that we've been talking a lot about charitable transactions, but your donor relationships are anything but transactional. They're transformational. Trust me, we certainly know the difference and value the same relationships with our clients. Thank you again for joining us, and we look forward to seeing you all on the 24th.
Thanks for joining us, everybody.
Thank you. Enjoy the rest of your day.